Good morning, everybody. Welcome also on my behalf for the Friday morning session here, and congratulations for having had the courage to early on want to dive into data and analytics in order to maybe shed a light in a bit more objective fashion on sources of skill. Because indeed, as Peter said, what struck me when I first entered the industry here 15, 20 years ago is that if you listen around the hallways, the GPs tend to all naturally say great things about themselves, but they also say very similar things about themselves, right? Everybody is top quartile, we know that. But they're also all risk mitigation skills rich. They have their own proprietary deal flow. They're uniquely positioned. They're operationally active. You know this all. And it's sometimes challenging to identify for whom this is true and for whom it's just basically singing what they believe the limited partners would like to hear. We're in business to look at this from an empirical fashion and run data on track records in the goal to identify distinct elements of skill in the track record. Now, for the most part, obviously, that is an exercise of distinguishing luck from skill with respect to generating value, generating cash. But that challenge has been elevated in recent years as there is a scarcity of cash coming back. And I heard this on the stage on another panel on Monday. It's not only that DPI is king or DPI is the new IRR. Somebody said DPI or die, and that's maybe true. The challenge in the absence of DPI, however, for many limited partners is to identify skill at the manager from different aspects of the track record. And that's going to be what I'd love to share with you this morning. There are a couple of distinct skills that you can analyze without relying on DPI. And the first of those has basically to do with the application of an old friend. You know, you've all been working with this kind of value driver bridge, which links the total return, or the alpha, as I like to use it in a given transaction, to the fundamentals of the investee companies. And you can basically break this down. You ask the question, how much is revenue-driven, margin-driven? That's an old friend. Now, I'd like to apply this typically deal by deal or for the whole collection of realized investments, because that gives me a feel for the value that actually has been created in the realized track record. It's very interesting actually to take the exact same concept and apply that to the still unrealized deals, possibly collectively. Now, what do you see? The NAV that's been reported, signals something, and it basically implicitly also can be linked to the value drivers. Now, imagine the unrealized track record, that's the picture you're seeing. The total returns are, in this case, in their totality explained already by objective EBITDA growth. Bit of top line growth, lots of margin enhancement. That's a happy picture for the unrealized portfolio. It makes me feel really good about the NAV that I'm seeing because I can see tangible progress. The deal seems to be on a good track. And then mind you, the multiple effect is negative. And importantly in our math, the multiple effect is not riding a multiple trend, it's active multiple expansion, because we mathematically decompose alpha. So we've already taken out the market-driven impact on performance and therefore can isolate on the active multiple expansion. Here we got multiple contraction, which is typically a bad sign, but on an unrealized deal, multiple contraction is just a sign of what? Conservative and valuation policy, right? Because you're assuming that you're holding the assets at valued less than what the stock market appreciation would suggest. So that's a happy chart. In contrast, you may see something like this in the unrealized portfolio. Right? You see alpha reflected in the NAV. However, that alpha, has a top-line driven component related to it, but you're growing at deteriorating margins. So at least partly you may just be buying market share. And then you get that big multiple effect component here, which is a very optimistic view on the valuation of the unrealized assets. That may be okay, but if you see this, ask the GP to show you the put options they have to sell these businesses to Tesla and to Google. Then it's all cool. If they don't have it, I personally, flying at 30,000 feet, I have my doubts about the solidity of that NAV. So that's an application of this value drivers to get a feel for what's going on in the investee companies. And we have a complementary way to decompose value, which now doesn't link it to the financials of the investee companies, but basically from an investment standpoint, ask the question, how much of the return is left over when you're basically peeling back the onion and you not only take out the broad market trend, but also the specific industry sector and leverage. And what you're left with on the very left here is what they call the delevered alpha. Somebody calls this the blood, sweat, and tear of the fund manager, or the pure gold of value creation. That's the component left over after you took out the market and the leverage and the sector. Again, I'd like to do this on the realized portfolio first. We have here 20% delevered alpha. You see the build-up. And then with the same logic, you contrast this on the unrealized portfolio, and you see, how the different components are basically, on the unrealized portfolio, reflecting delevered alpha with the same logic. In the unrealized portfolio, delevered alpha is just a reflection of your valuation policy. So diagnostics, they are contrasting realized and unrealized values, but we still obviously at some point in the realm of performance measurement. If you are looking at more in depth the same tool, this value driver tool, you can get very nuanced insights into the actual value added skill of the fund manager. And the way this works is to apply the same tool, but not only apply it in the rearview mirror, but basically apply it at different points in time. Now, I've become a skeptic over the years. I don't believe the GPs much if I don't see it in the archival data. So I don't like to ask them, hey, on this deal, what magic happened? How did you generate the 3x? But instead I ask the question, show me the investment memo when you underwrote it. Because that goes to investment committee. They're buying the company in a certain set of financials. They make projections that, yeah, they're going to hopefully triple your money. But they also make projections with respect to the underlying financials. And so implicit in this initial investment memo, there is an expected value creation bridge. And I like to paint this picture on this factual data and say this was the expectations. They wanted to generate 10% alpha, and this was the value buildup that they had projected. It's very powerful then to show you a little movie of different points in time, where for this particular deal, same deal, you would say that after 2 years, could be COVID, could be something else happening. In this case, a large competitor with pricing power in that industry came up, slashed the prices. So the top line growth projections that we had were obsolete. We knew we were facing headwinds and revenues were going to contract. So the GP had to say, well, we've got to step in here. We can't control the market. We can't control efficiency. Let's work this asset really hard and counter the negative revenue trend in order to still get to a positive EBITDA evolution. And the expectation was that we're going to get lower returns overall, but hopefully we'll still get home safe. Then after 1, 2, 3 of those interim snapshots, you can come in and say, well, let's now look on the rearview mirror. They actually sold this asset in this case. And sometimes, hard work is rewarded by luck. They found a strategic acquirer, paid them a huge premium, hence the active multiple expansion. But you can also see that what they had predicted works out because there was a contraction in the top line. There was a positive EBITDA evolution. It just looks small on the chart because the multiple effect was so large as somebody paid them a premium because they were able to grow EBITDA in a contracting market. So the same tool that we all use typically in the rearview mirror now apply to different points in time and giving you a quite nuanced ability to link what you see to the actual value creation story and impact of the fund manager. I'm going to take you one step further now because we pride ourselves in our ability to measure and benchmark not only the how much of value creation, but the how. This gets a little bit at the how, but we can actually run math on something much more qualitative inherently. As I said before, one of the things many managers claim that I hear out there is we got our own proprietary deal flow. Now, regrettably, I cannot walk into anybody's office and measure a proprietary deal flow, but I would argue I can do some math that's reflective of that. And this is how it works. It's mathematically super simple. I count. I count the number of deals the GP has done quarter on quarter. That gives me a curve of activity over time for that particular fund manager. Now, I can compare that curve of activity for one GP with the curve of all the other GPs taken together, so total deal value of buyouts quarter on quarter. And if I say compare, mathematically speaking, that means correlating. And if the two curves are very similar, the GP is swimming with the stream, highly correlated to the broad market, I call this pro-cyclical. It's nothing to do with cyclical industries. It suggests that they're investing with the cycles of private equity investment activity. And if they do so, I have no reason to believe they have any proprietary deal flow. They're just acting when people see lots of deal flow and the M&A shops are crazily shopping around deals. If, however, as in the case of this example here, they're dancing at their own rhythm, they have a low correlation between their own deployment pattern and the market. You see the 24% correlation here. This is not client data, this is commercially available data on Montague, a firm that we actually won as a client on the back of this. Because like many, they said, we never did auctions, we actually have our own deal flow. we ran the analysis, we could see with a 24% correlation to the market, they're very uncorrelated. They're actually dancing at their own rhythm when it comes to deal activity. So here there's a data point to substantiate that they probably have a reason to claim proprietary deal flow. Because you're only dancing at your own rhythm if you either see deals at points in time others don't see it and or are very disciplined in underwriting. And what we always do, we always do a little set of math to identify a comp set for every fund, similar funds in terms of underlying deal activity. And so we situate the GP here in the broader competitive space they're acting, and also they're sitting at the very bottom of this. And a low score here, as you've guessed, is a good thing. Intuitively, being non-correlated with the market is nice, and empirically, it actually correlates with higher returns. No causality. I would launch a fund, I would do deals at stupid times, my performance is lousy, I would look good on this score. But if you find an outperforming manager, that may be one of the drivers of outperformance that you can actually measure. Now, my favorite example for this metrics is actually on this chart here. This is a couple of years ago when Apollo was raising the huge 2019 fund. Several of my LP clients asked us to analyze Apollo, and again, we did this on commercially available data. And we saw the result here. A much higher correlation, much more pro-cyclical, which at the time surprised many of the LPs we talked to because, of course, Apollo, the great contrarians, everybody expected them to be very uncorrelated or counter-cyclical. So we went to see them in New York City, said, this is what we're doing, this is the result. Help me out here. Is my math wrong? Is the data I got on you wrong? Or is the widespread LP belief inaccurate? And they literally smiled and said something along the lines of, yeah, Oliver, we kind of like that the LPs think about us as the great contrarians. We know it's not actually true, so the math is right, the data is good. Didn't make a sale because they had no reason to put this on their shop window. But it clearly showed that the algorithm could pick up something I could not have imagined. Now, Apollo was a fantastic firm. Apparently, you may or may not want to invest with them, but don't invest with them to look for a contrarian, because they don't seem to be as much of a contrarian on this measure as people would have expected. Now, the toolkit I'm presenting has been relatively stable since I created the business 12 years ago. Just because people told me I shouldn't come up with 10 more metrics every year, it just confuses people. There's one dimension I will add this year, and that takes this concept of kind of how do you time with respect to the market overall, not on the exit, not on the entry, but on the exit activity. Because yes, DPI is king, and many GPs, if they have DPI, brag about getting money back to LPs, and that's fantastic. But I would argue it's another chance to detect skill, because there is not only the question of how much DPI do you generate, but also when do you generate it, right? Have you been able over the last 4 or 5 years to give back money at times when others couldn't? Or did you get back money when the markets were relatively open? And I'm talking about real exits here, not NAV lending or continuation vehicle type exit, but the actual ability to create a sale of a company. And the same logic here, we would do an analysis on the exit activity quarter on quarter and correlate that from one GP to the market overall. Turned out to be pretty tough because the usual data sets are pretty reliable on entry information. They're a bit more sparse on how they cover the exits. So we ran our own large language models to basically gather our own data on exit activity. We got this now for 150,000 deals, so we can run this number as well as an indication of another distinct skill of the fund manager. Now, continuing the exploration of what we can do strategically in the recent track record, it's one metric that's a nice robustness check about how the GP has been evolving over time. We look at the characteristics of the companies acquired and compare those companies in the last couple of years to what's been going on like 5 to 10 years ago. And we basically track distribution across 3 dimensions, industry, size, geography, and get you a very top-down indication of where the GP is consistent or drifting. And the one element that's probably most of an area of concern that people look at is the drift in bite size as AUM has been evolving. But you can also detect here how our managers evolving geographically and with respect to industry distribution, which gives you a nice kind of top-down view of what's going on. The consistency is important, but I would argue it overlooks something because you may keep doing the same things as before, but still you face very different environments. Let me illustrate this. You heard from both Orlando Bravo and Robert Smith here the last couple of days. They invented software buyouts. When they started doing this 20 years ago, it was super original. They still do the same things, basically, do a little larger, but do the same thing. So they were very consistent in their positioning. Yet that doesn't capture the other important element, which is the element of whether what you're doing is original or mainstream. And that basically determines how much capital is looking at your deal type, how much money is chasing deals. Now, how do you conceptualize this? I like to have a measure that allows me to position every private equity fund on a scale from niche to mainstream. How do I measure this? I'll look at the underlying assets, again, classified by their industry sector, size category, and country. And then I ask the question, what part of all private equity capital ever invested is flowing into that type of deal? Now, if you're buying out funeral homes in Portugal, you're probably the only one doing so. The score is 0, the perfect niche fund. If you were to invest pro rata like all the others, you could have a score of 100%, but the highest scores we've ever seen are in the 6, 7, 8% area. So we get an objective measure that tells us fund by fund, where are you in the evolution? And that measure basically allows us to build a very powerful early warning indication on how the fund manager has evolved strategically. Now, imagine you're doing diligence on a fund. There had the last 3 funds presented like this. The score in blue is the manager we're diligencing. The score in green is, again, the aggregate score of their comp set. And then imagine that manager has been growing like many and is asking you for even more capital for the next fund. This is a big red flag going up, right? This is a case where the manager clearly has been pushed out of their niche into the mainstream. They lack the ability to deploy that additional capital already on their Fund 5. So if they ask for even more in Fund 6, a big red flag should go up because I get big doubts about their ability to deploy that capital efficiently. And that, importantly, is a beautiful early warning indication because the Fund 5 in this case is very likely too young to be judged from a return standpoint. The deals have happened. So I can conclusively judge the strategy and infer from there the degree to which they've been able to deploy that capital or not in an efficient fashion. Now, this is not Vista or Thoma Bravo data, but you could well imagine that those players have become more mainstream. Now, they didn't drift, like they're still doing the same stuff as I said before, but the mainstream came into their territory because software buyouts were original 20 years ago, and lots of folks found out that they can be very attractive. So lots of people try to get into this market segment. So even though you may be consistent in your strategy, the competitive dynamics around your deal flow may still change. And you can imagine different scenarios here. This is a happy case. This is a turnaround case of a manager who was raising a new fund. We show the strategic positioning here while we basically know the performance story to this manager. Stellar fund 2012, lousy fund 2016, 2021 too early to judge. Now, what do you make out of this? The manager tells a story. We were fantastic. We made some mistakes. Trust us, we're back at our strength. Now, that trust is something you cannot substantiate with the 21 fund performance because you don't see that yet. But in this case, the analysis of the strategic positioning should give you some confidence because it matches with the story, right? They went mainstream in the 16 fund. That hurt performance. 2021 fund looks very differentiated again. So some reason to believe that for them the story may actually be true. And that's why we're in business. We always want to give the LPs data points where we can say, well, we hear all this stuff from the GPs. Let me look in the data to see where I actually find evidence to believe it and where it is a little bit less reliable to do so. So I hope I've given you a little bit of a feel for the fact that even if there's no cash coming back yet, there are very specific and concrete things from a data perspective you can do to read from the track record these very clear indicators of different skills of the fund manager. We have a whole toolkit of those. We can measure downturn resilience. We can measure fundamental value add. We can measure risk mitigation. And always give you as an LP then the ability to say, hey, let me diagnose this rather than blindly believing everything I hear in the corridors here. I see the next panelists coming up, and they're continuing, as I understand, on a very similar theme of detecting manager skill. So if I have a minute or so, I'm happy to take a question if anything has not been sufficiently confusing yet. Any questions, comments on the material I presented? Otherwise, I'll look at Peter, and thank you very much for your attention this morning, and have a good morning.